He said there's tons of capital out there, tons of fucking money that needs to be deployed. No deals. Fucking none. All right, next one. It's almost, I don't know if it's a new business opportunity. Here we go again, right? It's not necessarily a new business opportunity, but it might be something that we might be able to take down using Coachwood Capital.
Okay.
With Coachwood Capital, we're solving an issue. We're solving a problem. Returns are being restricted in Canada. That's not news, right? In order for us to get the returns that I was used to, we started going over to the States, right? We're on our third property now, or looking for our third, because the returns that we can get for Canadians in the States and the infrastructure that I built to allow Canadians to invest in properties over in the States with me is far greater than what you would be getting over here in Canada, per se. Now, another issue that I'm really seeing right now is people are struggling to afford housing. Would you agree?
Absolutely.
What if we introduced a rent-to-own scenario with Coachwood?
Okay.
So we got into the residential side of real estate as well
for Canadians,
not in the US. Not in the US.
Yeah.
I wouldn't do this in the US and I would only do this local, I feel.
Okay.
Maybe not. Who knows? Down the street, down the road, I don't really know. But I feel that the ability to solve the problem of real estate affordability for people would be very interesting to introduce to Coachwood. Like, very interesting, actually.
So what are some of your thoughts in terms? Well, first of all, like for anyone listening that doesn't understand like what that actually is, like explain even like how it would work from a rent to own person's perspective.
Yeah. So there's a lot of ways to do this. I haven't looked into the most effective ways to do this that have maybe this has been done for sure. Like I'm not like reinventing the wheel here or anything, but again, I think with our reach and our ability to utilize technology to do this to scale might work better than what other people might be able to conjure up. So I think we might be onto something with this. So a rent to own scenario would be, say for example, your rent was like, say you didn't even have any money. Say there's all kinds of scenarios, okay? Maybe you're an entrepreneur, okay? And banks don't like entrepreneurs. You don't have a steady stream of income, okay? Right? Remember that? You were a personal trainer and then you were having a problem?
Yep.
So maybe you got a divorce.
Or even when I started working with you, I was a contractor versus a full-time regular employee.
Which is so fucked, but it is what it is.
Yeah, I know.
Maybe you recently got a divorce, but you have good income, and like that's another thing that'll affect your credit. Maybe you're new to the country, right? Which this is like we're bringing in 500,000 people a year that need housing. Maybe you're new to the country, but you're an engineer, you got a great job, but it's not some, you haven't been in the job market all that long to develop the credit that you need, yada yada yada. Maybe that. I don't know. I don't know what. There's all kinds of different scenarios, right? Maybe you don't have enough of a down payment. Maybe you don't even have 5%, but you got a great job or something along those lines, right? Well, and with the pricing of homes right now at like $500,000 or $400,000 or whatever, maybe you don't have the $20,000 or the $40,000 for a down payment, right? So maybe, as an example, say you have a $400,000 home, a $5,000 down payment that you would need is $20,000. So maybe
5%.
5%, yeah. Say you got the CMHC. Say it's your first time home, the first time you're buying a home. Actually, let's use that as an example. It's your first time buying a home. 5% CMHC insured mortgage, 5% down. So you need $20,000, right? So maybe for the first 20 months of home ownership, you're putting down an extra $1,000 plus your $2,000 in rent, right, for the down payment. Or maybe say, for example, 1,500 of that is rent. 500 of that goes down to, or gets applied to a, your principal, and then an extra $1,000 a month gets applied to the down payment, something like that. Or maybe it's amortized over 25 years, and maybe we accept a 90-20 LTV, right, where it's a little bit less, and they either give it to you or we add it on. For example, a $400,000 home, say for 40 months, you have to give us, $1,000 extra, right? And then we do a regular 25-year amortization, or maybe a 30-year, or it's like we get a little bit more creative to make it affordable for these people to be able to, buy a home, right? While also making it advantageous for us. So say, for example, maybe rates are at 6% right now. Maybe we do 8, maybe we do 10. So it's almost like a private lending scenario, but we do it with homes that we own, right? So that if shit actually hits the fan, in a private mortgage scenario in Canada, you can't take the house back.
Right.
Okay? What you can do is you could force a sale of the home, and it takes a long time. In this kind of scenario, you do a regular eviction, or I can't remember exactly what my lawyer mentioned. He mentioned a bunch of shit. I don't fucking remember. But it's not a scenario like, I'll actually bring it up for you. Now, this is like totally, let me see here. David Howell. Okay. So this is, I put easy to structure. Are you seeing more of this lately? Is there a high rate of delinquency? Also, what happens if there is delinquency? Can the landlord assume the property back? He wrote yes and no. We have good precedents to go from, though. Personal guarantees, and they pay everything. And if they don't, you kick them out and take their stuff and sue them for unpaid rent. So there's a lot of nuances, I'm assuming, like with respect to this. In Canada, you can't just like lock the door like a commercial property or industrial property and that's it if they don't pay rent. But this is a really interesting play, I feel. I feel like this is a very interesting play.
So essentially, you would transition ownership or a sale. You would sell them the property at the point that they reach like the 5% down or 10% down.
I don't know. I have to meet with Dave. I don't know all the nuances. I don't know what the best practices are for this.
But even just conceptually having where there
might be a trigger, right?
Right. Where you're starting off, it's essentially just, it's a rental where it's like traditional real estate investing.
Yeah. And I don't know if there's like a trigger point where like say, the trigger point is, once the 10% after 40 months or whatever is actually paid. Right? Maybe that's the trigger point. Or maybe you have to get into an ownership deal right from the onset of even the rental period or the rent to own period. I don't know what the nuances are. We can get into a further discussion about what those nuances are, later down the road. But
did he bring it up or did you bring this up, or did he bring it up originally?
About doing this
concept, yeah.
No, I did.
Yeah. And
I think it's interesting.
It is very interesting.
Solves a problem.
Yeah.
That's a really fucking big one right now.
And what is the landscape right now for private mortgages? Let's say in the last couple of months, like what are you seeing? Is there like a higher demand for private mortgages? Is there a lower demand? It's kind of the same.
Speaking of which, I just got like literally about half hour ago these guys just hit me up and they're like, "Hey, can you do a $5 million private mortgage?" Like I don't know the details of that, but that's a fucking big one. But I don't So I have also a buddy that does a ton of private mortgages. He said there's tons of capital out there, tons of fucking money that needs to be deployed. No deals. Fucking none. So this might be a situation where we actually bring in private mortgages, right, as to fund these fucking deals for people. Yeah. You see what I'm saying?
I know for example, for my age group or generation or whatever you want to call it, like the demand for something like that would be absolutely huge.
I think so.
Right? Because I even think about it from like the demand perspective. The number of times that I've heard people being like, fuck, I want to like move out of my parents' house, but I don't want to, but they're also pretty financially literate, and they're realizing that they don't want to just throw money away to rent. So they're essentially going to be staying with their parents until they're 35 years old because they want to just be able to move into something that they own, right? Because the affordability is kind of running away from what wages are. But if you had a rent to own situation, like their incomes are good, they're making 80 grand a year, 90 grand a year, whatever. But they're not going to be able to, like, with how fast housing prices are increasing, having some, like a rent to own, like I know that they'd be able to get
housing prices aren't increasing like now, but
I'm just saying over the last couple of years.
Yeah, interest rates are going right, but like, okay, so what kind of scenario right now that you've seen with your friends that are like not able to get homes? Like, what is the scenario? Do they not have enough of a down payment? Is their credit shit? Are they new in the job market? Like, what is it? Because I'm 10 years older than you, so what's the the majority of my friends are established, pretty much all of them, to be honest. So what's the hurdle that you see with your demographic or the younger demographic or whatever?
So it's a combination of where they now have an established job, they're having a good income, but when they're trying to apply for mortgages as an individual, once you have a partner, let's say, for example, you're going in with a girlfriend, fiance, wife, whatever, like, and they also have that income, like that helped me a lot, having two incomes going towards it, right? I'm not going to lie about that when it comes to the application. But the friends that are trying to go after something, let's say $500,000 or even $400,000 on one income, is very challenging.
Is that right?
Yeah.
They're still seeing a hard time.
And they're having like senior engineer jobs where they're making 80, 90 grand a year, like they're secure jobs.
So what is the problem? So okay, that's the problem. But what is the solution to the problem that they're seeing? Like, is it so shitty LTV? They have to put more down. Like, what is it?
They would have to essentially put more down just because the debt service coverage ratio would just be too high based on what their home income is versus
so the
cost of the debt right now.
Basically the banks have like a one, like, I don't even know what on a residential, do you know what the like if you were to buy your own principal resident, what the debt service coverage ratio is?
I know, like, in terms of your the gross, one's like 37%, one's like 33%
of your gross pay.
Yeah, what do they call it? The gross service ratio.
I don't know. I don't even remember on like a personal side. I don't even know what that looks like.
I just went through this like not long ago. I'm trying to remember what those numbers were.
Whatever, I can find out.
Well, this is going to be important for the thing, just because a lot of people are probably in a similar situation as me. I just need to remember the word. It's called gross. Has two acronyms.
Multiplier?
Yeah, even when you look at private mortgages, you look at a gross one and a total one. Yeah, GDS and TDS, that's what it's called.
Okay.
Your gross debt service and your total debt service. Okay. Yeah. So to reiterate this, essentially what's happening right now is that the gross debt service and the total debt service, especially in the last year, has tightened up substantially, right? And essentially, as a ratio of what your income is, the percentages of what the allowable payments are per month has tightened more and more. Whereas, like, let's say 2 years ago, it was 50%, then dropped to 45%. Now it's at 40%, right? So it's getting tighter and tighter. So in terms of your total debt and your gross debt, you want to have it where the banks will look at it to be under a certain ratio. And so the issue is that a mortgage on a $400,000 house went from $1,600 to $2,500 in the matter of a year, and that on a ratio of a 80 grand income, you're no longer within those limits.
Yeah.
Right.
So this is what I'm talking about, right? Like we could stretch the limits, right? We could be the bank that could stretch the limits for people and assume the risk where, we could pull in private money, give these people a return, right? And assume the risk if they default, because I have the income to support a default. You see what I'm saying?
What do you think, from when you're talking to like your guys in private mortgages, what interest rates are they typically looking at? Because I know, for example, like if you were to be able to be in a 6 to 8% range, people would do that all day long.
Yeah.
I just don't know if private mortgage lenders would actually be interested in anything even less than 10%, would they?
Probably not at this, like private lending is still around 10 to 12%, which is fucking crazy because rates are so high. But at the same time, it's It's just where the market is, right? Like
Yeah.
I again, my buddy that does a ton of these, he's just like, yeah, it actually makes sense that private mortgages would the spread between the bank's mortgage rate versus the private mortgage rate, which should be higher right now, but nobody would be able to afford it. So it's irrelevant. The higher, I remember I did a 28.5% private mortgage on $100,000, but it was a business, right?
Right.
So the business was making money. It wasn't somebody, at a fixed income, trying to make those crazy payments, right? So that's the only. I would love to figure out a really solid model for doing this, because I have a bunch of single family homes that I could actually apply this to.
Yeah.
Right. That I think would be very fucking interesting.
I think it would also be enticing to call it the customer or tenant or whatever you want to call it, the buyer. It would be very interesting from their perspective that they don't have to rely on the private mortgage for the entire length of the term.
Yeah.
Right. If you were to have it where, okay, let's say you're paying your down payment over the course of a 2 to 5 year period. And then after that point in time, you have the ownership, but then also you have if we were able to essentially provide a proof of payments over a course of a period of time, let's say as like a letter, like an official letter from us as Coachwood Capital that we can provide to them, that then goes to the bank and saying, hey, they're in good standing for payments over the last 2 to 5 years, so that they could actually then go and apply for a traditional mortgage themselves.
Well, that would be so that would be the part 2 to this. The part 2 to this is not only offering the service, the part 2 would be the coaching of it. So typically what would happen is you have to get your money out. So one of the ways that you would get your money out is obviously strengthening the buyer.
Right.
The buyer is in a position that they can't get traditional funding, right, or lending. Well, how do they get traditional lending? Fucking help them do it.
Yeah.
Right? So figure out a way, like, is their credit shit? Coach them on getting better credit.
Because almost everyone in a matter of 2 to 5 years can really improve
it wouldn't even take 5. It would take like a year or two. Like